Imagine this. You've poured your heart and soul into building a thriving business. Every decision, every innovation, every dollar spent have been meticulously planned, right, to maximize efficiency, grow your bottom line.
Right.
But here's the critical question, the one that maybe gets overlooked sometimes. Are you truly optimizing your corporate tax strategy? Or could you be inadvertently leaving significant money on the table?
A very real possibility for many.
Yeah. So today, we're not just looking at, another tax form. We're really digging into how to uncover those powerful, maybe sometimes hidden pathways to maximizing your corporate tax savings.
Enter guide.
Our blueprint for this deep dive. It's the 2024 instructions for Form 1120, the U.S. Corporation Income Tax Return itself.
The source document.
Exactly. This isn't just about compliance, ticking boxes. It's about mastering a strategic tool for your financial health. We're going beyond the basics today to reveal how this, well, seemingly mundane document holds the keys to some profound tax efficiencies.
That's precisely right. Our goal for you, the listener, is really to walk away from this deep dive, not just informed about the rules, but genuinely empowered, with practical, actionable knowledge.
Actionable is key.
Absolutely. We're going to distill this sometimes complex IRS guidance into clear, strategic insights. We'll focus specifically on those critical deductions, valuable credits, and crucial compliance details that can really dramatically impact your corporation's financial health.
Kind of like decoding the manual.
Exactly. Think of it as decoding the IRS's own manual to find those legitimate tax savings and, just as importantly, avoid those costly missteps.
Okay, let's unpack this then. When we talk about Form 1120, we're really talking about the bedrock, the foundation of corporate taxation in the U.S. What exactly is its core function? Why is it so fundamental for domestic corporations?
Right. At its core, Form 1120 is, it's the primary tax return that domestic corporations use to tell the IRS their financial story for the year. Simple as that, almost.
Oh, story.
Yeah, it's where they report everything. All their income, any gains or losses they had, the deductions they're claiming, the credits they're entitled to.
So it all funnels into this one form.
Pretty much. Ultimately, it's the document that calculates their federal income tax liability. So for any business structured as a C corporation, this form is, it's non-negotiable.
Right.
It's that annual financial snapshot where every operational detail, from sales revenue down to the utility bills, it all funnels down to that final tax number. It's where your financial performance really meets the intricacies of tax law.
Okay. So who absolutely must engage with Form 1120? Because I can imagine there are tons of different entity types out there. Getting the right form from the start seems paramount to avoiding penalties, saving headaches, saving money.
You're hitting on a really crucial point there. Primarily, all domestic corporations have to file Form 1120.
Okay. Standard C Corp.
Right. And that includes corporations that might be currently in bankruptcy, interestingly enough, unless they specifically qualify for or elect a different kind of return. But here's where it gets particularly interesting for a lot of businesses, especially newer ones. If your entity started as something else, like, say, a limited liability company, an LLC.
Which are really common now.
Very common. But you've elected to be taxed as a corporation, then you also must file Form 1120.
Ah, okay. That's a significant distinction. How does an LLC actually make that choice, that election, to be treated like a corporation for taxes?
Good question. It's done by filing a specific form, Form 8832. It's called the Entity Classification Election.
Okay, Form 8832.
Right. And if an LLC makes this choice, they then have to attach a copy of that Form 8832 to their Form 1120 for the year the election actually takes effect.
So you have to show the IRS you made that choice.
Exactly, because without that specific election, an LLC is generally treated by default as a partnership.
Filing Form 1065.
Right, filing Form 1065. Or if it's just a SNUS-member LLC, it's usually considered a disregarded entity, meaning its income and expenses just flow through to the owner's personal tax return. So you see, the mere act of choosing your tax classification can completely change which form you file. It really underscores how important it is to confirm your entity type, your tax status, before you even think about starting your tax return.
Definitely. So beyond the standard C Corp or an LLC that's, checked the box to be a C Corp, are there other, maybe less obvious entities that still end up filing a Form 1120?
Oh, absolutely. The instructions actually point out several unique situations. For instance, corporations whose main business is farming, unless they're a specific type of cooperative, like a subchapter T Coop, they still use Form 1120.
Okay, Farming Corp.
Yeah. Another kind of nuanced area involves corporations that hold an ownership interest in something called a financial asset securitization investment trust, or a FASIT.
Facet.
Sounds complex.
They are. They're usually complex financial vehicles, often involved in securitizing assets like mortgages. Because they have unique tax treatment, these corporations need to attach specific statements to their Form 1120. More paperwork.
Usually, yes. Then you have a really interesting situation where a foreign person owns a domestic disregarded entity.
Okay, so a U.S. entity, but owned from abroad and usually disregarded.
Right. Even though it's disregarded for most U.S. tax purposes, for certain reporting rules specifically related to transactions with foreign owners under Section 6038A.
Ah, the reporting rules.
Exactly. For that purpose, they're treated as domestic corporations, which means they actually have to file a pro forma Form 1120.
Pro forma, like a placeholder.
Kind of. It's essentially a skeleton Form 1120, and its main purpose is to have Form 5472 attached, which reports those foreign-owned transactions. It's really a specific anti-abuse or transparency provision.
Got it. Keeps things above board.
Supposed to. And a really major point of interest in recent years, qualified opportunity funds, or QOFs.
Right, OZ funds.
Exactly. These are investment vehicles designed to spur economic development in designated low-income communities. To certify as a QOF, a corporation must file Form 1120 and attach Form 8996. And here's the kicker. They have to file even if they have absolutely no income or expenses in that year.
Wow. Just to maintain the status.
Correct. And if you, as a corporation, hold a qualified investment in a QOF, you also have to attach Form 8997 to your own return. So you can see, Form 1120 isn't just for your traditional widget-making C Corp. It's a foundational document for a surprising variety of specialized entities.
That certainly highlights the complexity. So let's flip it. To prevent misfiling, which sounds like it could easily happen, which entities should not be using Form 1120? Which ones require a different specialized return? Because filing the wrong form, I imagine, just causes delays and headaches.
It's a very common pitfall, absolutely. And yeah, it can cause significant administrative headaches, potential penalties. It's worth getting right.
So who files something else?
Okay, so to avoid those issues, it's critical to know who files special returns. For example, if you're an exempt organization like a nonprofit, but you have unrelated business income.
Like a museum gift shop or something.
Exactly, a for-profit side venture. You'd file Form 990T for that income, not 1120. Religious or apostolic organizations, they actually use Form 1065, the partnership return.
Interesting.
And as we mentioned, LLCs treated as partnerships also file Form 1065. Cooperative associations, like many farmers' cooperatives, have their own specific form, Form 1120C.
C for cooperative. Makes sense.
Right. Then you get into the really specialized entities. Real estate mortgage investment conduits, REMICs, they use Form 1066, actually, not 1120 REITs. Property and casualty insurance companies file Form 1120 PC.
PC for property casualty.
Yep. Political organizations like campaign committees use Form 1120 poll. Real estate investment trusts, or REITs, they file Form 1120 REITs.
Have 1120 meet.
And regulated investment companies, RACs, think mutual funds, they file Form 1120 REIT. And perhaps most importantly for many small and medium businesses, S corporations. They have that pass-through tax treatment where profits go directly to shareholders. They file Form 1120S.
Right. Definitely not 1120.
Definitely not. And lastly, settlement funds, usually set up for litigation settlements, they file Form 1120SF. So the takeaway here is crystal clear. Always, always confirm your entity type and its specific filing requirements before you even begin preparing your return. It saves so much hassle down the line.
Absolutely. Good advice. Okay, so we've covered who needs to file Form 1120 and, importantly, who doesn't. Now let's get into the practicalities, the how and the when of filing. Getting these administrative details right honestly feels like the first step in avoiding unnecessary headaches and therefore unnecessary costs. Compliance here is a tax-saving strategy in a way.
Absolutely. Couldn't agree more. And the big push from the IRS now is electronic filing, e-filing.
Right, they want everything digital.
Pretty much. For returns filed on or after January 1, 2024, corporations are generally required to e-file Form 1120 and all its related schedules and forms if the corporation files. Get this. 10 or more returns of any type during the calendar year.
10. That seems like a low threshold. What counts?
It is pretty low, and it's broad. It includes income tax returns, sure, but also employment tax returns like Form 941, excise tax returns, and importantly, information returns like W-2s or 1099s.
So most businesses will hit that easily.
For most established businesses, yes, this means e-filing is now basically the standard. And, there's a major benefit to e-filing. If you owe a balance, you can often authorize an electronic funds withdrawal directly from your bank account.
Oh, convenient.
Very. It simplifies the payment process and it helps ensure it's timely, avoiding those late payment penalties.
Okay, but what if a corporation genuinely faces a hardship? Maybe they're in a remote area, or there's some other reason they just can't e-file. Are waivers available?
Yes, the IRS does provide a way out if there's a real hardship. If a corporation can demonstrate that e-filing would cause, undue hardship, they can request a waiver of the electronic filing requirements.
How do they do that?
These requests have to be submitted in writing. You mail them to the IRS Ogden Submission Processing Center, or you can fax them to 877-477-0575.
Okay.
There's also a specific exemption for religious beliefs. If using the required technology conflicts with the corporation's sincerely held religious beliefs, they are exempt. In that case, they just need to write religious exemption prominently at the top of page 1 of their paper, Form 1120.
Good to know. Okay, let's talk deadlines, crucial stuff. When is Form 1120 typically due?
The general rule, the one most people know, is that a corporation must file its income tax return by the 15th day of the 4th month following the end of its tax year.
So for a calendar year corporation ending December 31st, that's April 15th.
Exactly, April 15th. However, there's a specific kind of quirky exception. If your corporation has a fiscal tax year that ends on June 30th, then your due date is actually the 15th day of the 3rd month after your tax year ends. So that would be September 15th.
Huh. September 15th for June 30th year ends.
Yeah.
Good detail.
It is. And of course, like many tax deadlines, if the due date happens to fall on a Saturday, Sunday, or a legal holiday, you get a little breathing room. You simply file on the next business day.
Standard procedure.
Mm-hmm.
And if a corporation just can't make that deadline, maybe they're waiting on information or things are just complicated, what's the procedure for getting an extension? Managing timelines without penalty is key.
Right. And thankfully, there's an automatic extension available. You use Form 7004. It's the application for automatic extension of time to file certain business income tax information and other returns.
Form 7004.
Yep. By filing this form by the original due date of your return, you automatically get an extension of time to file, usually 6 months.
Okay, automatic 6 months. Easy enough.
It is, but, and this is a huge, but it's vital to remember that an extension to file is absolutely not an extension to pay.
The money is still due.
The money is still due. Any taxes you estimate you'll owe are still required to be paid by the original deadline to avoid interest and penalties. That trips up a lot of people.
Good warning. What about mailing? Can you still use snail mail?
You can, but besides the U.S. Postal Service, the IRS also designates certain private delivery services, or PDS. You can find the list on irs.gov.
Like FedEx or UPS?
Often, yes, the list specifies which services qualify. Using one of these can also satisfy the timely mailing as timely filing rule. Just one caution. These private delivery services cannot deliver to P.O. boxes, so make sure you have a street address for the IRS center.
Gotcha. Okay, signing the return. Who specifically has the authority to sign the corporate return? Can't be just anyone, I assume.
No, definitely not. It's quite specific. The Form 1120 must be signed and dated by an authorized corporate officer.
Nice.
Typically, this includes the president, a vice president, the treasurer, assistant treasurer, the chief accounting officer, or any other corporate officer who has been specifically authorized by the board or bylaws to sign.
Okay, senior people.
Right. And in cases where a corporation is in bankruptcy, it's the fiduciary, like a receiver, trustee, or assignee, who must sign on behalf of the corporation. And their signature needs to be accompanied by a copy of the court order that actually authorizes them to sign. It's all about accountability for the information reported.
Makes sense. Now, for businesses working with a paid tax preparer, which is most, I guess there's that little box in the signature area about authorizing the preparer to discuss the return with the IRS. That seems like a really handy feature for streamlining things, right? Maybe saving some time and hassle.
It absolutely is. It's a great tip for compliance and just resolving minor issues quickly. By checking the yes box there, you grant the IRS limited authorization to discuss your 2024 tax return directly with the paid preparer who actually signed it.
So what can the preparer do with that authorization?
It's incredibly helpful for routine stuff. It allows your preparer to answer questions the IRS might have about how the return was prepared, provide missing information if something small is left off, Call the IRS to check on the processing status of your return. Oh, that's useful.
Yeah, and they can even respond to certain IRS notices, like ones about mathematical errors or tax offsets.
Okay, but what can't they do? Are there limits?
Oh, definitely. It's important to understand the limits. This authorization does not allow the preparer to receive any refund checks on your behalf,
Good.
nor does it bind your corporation to any additional tax liability the IRS might propose. And crucially, it doesn't allow them to represent the corporation before the IRS in a formal setting, like an audit or an appeals conference.
So it's not like a power of attorney.
Exactly. It's purely for convenient, limited communication about the specific return filed that year. Very useful, but limited.
Got it. Okay, last foundational piece. The employer identification number, the EIN. Every corporation needs one. For new businesses, how do they get one? And what if it hasn't arrived by the filing deadline?
Right. The EIN is fundamental. It's your corporation's unique tax ID. The quickest and easiest way to get one is to apply online through the IRS website, irs.gov.
Online is fastest. Usually, yes. If your information is validated, you typically receive your EIN immediately right there on the screen. Alternatively, you can apply by faxing or mailing Form SS4 application for employer identification number, but that takes longer.
Any special process for foreign corporations?
There is a special note for foreign corporations needing an EIN. They can call the IRS directly at 267-941-1099. Just be aware, that's not a toll-free number.
Good tip. And the deadline issue. What if you applied but don't have it when you need to file, especially if you're e-filing?
Right. For electronic filing, an EIN is generally required at the time you submit the return. The only real exception is for subsidiaries that are included in an electronically filed consolidated return. In that very specific case, if the EIN hasn't arrived yet, they can enter applied for where the EIN should go. But for a standalone return, you really need that EIN before you can e-file.
Okay, so plan ahead on getting the EIN.
Definitely. It's a must-have.
All right, we've laid the groundwork: who, what, when, how. Now let's pivot to where the real savings can happen. Deductions. This is the heart of corporate tax strategy, right? These are the expenses that directly reduce your taxable income, lowering the amount of profit the IRS gets to tax. Knowing these inside out seems absolutely key to optimizing that tax bill. What are the foundational principles here?
You're right. Deductions are absolutely central to minimizing tax. The most fundamental principle is that for an expense to be deductible, it generally has to be both ordinary and necessary for carrying on your trade or business activity.
Ordinary and necessary. We hear that a lot. What does it really mean?
Well, ordinary means it's a common and accepted expense in your specific industry or line of business. It doesn't have to happen frequently, just that it's not unusual.
Wow.
Necessary means it's helpful and appropriate for your business. It doesn't have to be absolutely indispensable, just, conducive to the business activity.
Okay, helpful and appropriate.
Right. Beyond that core concept, a really crucial foundational rule revolves around your accounting method, because that dictates when you can actually claim those deductions.
Ah, the timing. Cash versus accrual. And there's been a significant change recently about who can use which method, especially for smaller businesses, right?
Yeah.
This sounds like a point many could easily miss, but could offer some real benefits.
Exactly. This is a big one. For many years, certain larger corporations were just flat out required to use the accrual method. Now, the rule is a bit different. A corporation or even a partnership that has a corporation as a partner generally cannot use the cash method of accounting unless it qualifies as a small business taxpayer.
Okay, so you need to be small to use cash method. What about tax shelters?
Ah, good point. Tax shelters can never use the cash method regardless of size. So if you don't qualify as a small business taxpayer, or you are a tax shelter, you're typically required to use the accrual method. This is especially true if your business involves buying and selling inventory.
Right, inventory usually means accrual.
Generally, yes. Forming corporations also generally must use the accrual method, though there are some specific exceptions for them too.
So the big question then, who exactly qualifies as a small business taxpayer under these rules? You said this offers simpler accounting options, which sounds like a huge potential aha moment, a real simplification, maybe even cost savings for many.
It truly is a significant simplification. For tax years beginning in 2024, a corporation qualifies as a small business taxpayer if its average annual gross receipts for the 3 prior tax years are $30 million or less.
$30 million average over 3 years. Okay.
Right. And it can't be a tax shelter. If you meet that threshold, you get a lot more flexibility. For instance, these small business taxpayers no longer have to deal with complex inventory accounting rules under Section 471.
What can they do instead?
They have options. They can account for inventory by treating it simply as non-incidental materials and supplies, or they can just conform to how they treat inventory in their applicable financial statements if they have them.
And if they don't have financial statements?
Then they can just use the method they use in their regular books and records. It dramatically streamlines record keeping and compliance for these smaller, well, up to $30 million average receipts entities.
That does sound much simpler. What if a corporation wants or needs to switch its accounting method? Maybe they grew past the small business threshold, or they just want to change. Can they just, flip a switch?
Unfortunately, no, it's generally not that simple. Changing an overall method of accounting, or even just changing the accounting treatment of any material item for income tax purposes, usually requires getting the IRS's prior consent.
How do you get consent?
Typically, you have to file Form 315-CON, which is the application for change in accounting method. Now, there are certain changes for which you can get automatic consent from the IRS, procedures outlined in guidance, but it's definitely not something to undertake lightly without careful planning and often getting professional advice. You don't want to make an unauthorized change.
Right, okay. So connecting this back to the bigger picture of deductions and savings. Many crucial deductions seem to be about timing and making the right elections early on. Let's start with those initial costs when a business is just getting off the ground, startup and organizational costs. How can companies leverage those for savings?
This is a really powerful area for new businesses to strategize about, absolutely. For both business startup costs and organizational costs, corporations have an election they can make. They can choose to deduct a limited amount immediately, right in the first year the business begins.
A limited amount, how much?
Up to $5,000 for each category. So that's potentially $5,000 for startup costs and another $5,000 for organizational costs for a total of $10,000 up front.
Okay, $10K up front sounds good.
It is. But there's a catch. These immediate deduction amounts are subject to a phase-out rule. If your total startup costs or your total organizational costs exceed $50,000, that $5,000 immediate deduction is reduced dollar for dollar for the amount over $50,000.
Okay, so if you spend, say, $53,000 on startup costs.
Then your immediate deduction for startup costs is reduced by $3,000, leaving you with only a $2,000 immediate deduction for those costs. So the benefit phases out completely if your costs hit $55,000 or more in either category.
Got it. So what happens to the costs you can't deduct immediately? The amount over $5,000, or all of it if you're over the phase-out?
Any remaining costs, the ones not deducted immediately, can then be amortized. You spread the deduction out over a 180-month period.
180 months, that's 15 years.
Exactly, 15 years. So you get a smaller deduction each year for 15 years.
So it's not a full immediate deduction, but a mix. Partial immediate with the rest spread out. How do you actually make this election to deduct and amortize?
The election is generally made pretty simply. You just claim the deduction on your income tax return filed by its due date, including extensions, for the tax year in which your active trade or business actually begins.
Okay, so it has to be the year you start operations, not just incorporating.
Correct. The year the business becomes active. Now, what's really crucial for planning and a nice bit of flexibility the IRS allows, if you happen to file your original return on time without making this election, maybe you just missed it, you still have a window.
Oh.
Yes. You can still make the election by filing an amended return within 6 months of the original due date of your return. Importantly, that's 6 months from the original due date, excluding any extensions.
Go ahead, 6-month second chance. Good to know.
It is. When you file that amended return, you must clearly indicate you're making the election under Section 195 or 248, and you should write, filed pursuant to Section 301.9100 attached, right at the top of the amended return.
Okay. And once you make this choice, amortize or capitalize, can you change your mind later?
No. That's the key. Once made, this election, whether you choose to amortize or you choose to just capitalize the costs and not deduct them until the business ends, is irrevocable. It applies to all the startup costs related to that specific trade or business. So it's an important decision to make early on, as it can significantly impact your cash flow and taxable income for years, especially when you're just trying to get the business stabilized.
Definitely a strategic decision right out of the gate.
Yeah.
Okay, moving beyond startup. Charitable contributions. Another significant deduction, but I know there are specific rules about timing and limitations that businesses really need to nail down to maximize the savings here.
They absolutely do. The basic rule is that contributions or gifts that are actually paid within the tax year to or for the use of qualified charitable and governmental organizations are deductible.
Paid being the key word.
Generally, yes, for cash basis taxpayers. This also includes any unused contributions you might have carried over from prior years. We'll get to carryovers in a moment. Now, for corporations that report their taxable income using the accrual method, there's a particularly powerful planning tool available.
Oh, what's that?
Accrual method corporations can elect to treat contributions as paid during the tax year, even if the cash doesn't actually leave their account until the next year.
Really? How does that work?
There are two conditions. First, the contribution must have been authorized by the corporation's board of directors during the tax year you want to claim the deduction in. Second, the contribution must then be actually paid by the due date for filing that year's tax return, and importantly, this is the due date excluding any extensions.
So you need the board resolution in year 1 and payment by, say, April 15th of year 2 for a calendar year filer.
Exactly. If you meet those conditions, you need to attach a declaration to your return stating that the board resolution was adopted and the date it was adopted. This can be a fantastic way for accrual basis corporations to manage their cash flow, maybe make larger year-end giving decisions, and still secure the deduction in the current year. Great planning tool.
That does sound useful. Now, isn't there a cap, a limit, on how much a corporation can deduct for charitable contributions in a single year?
Yes, there absolutely is. Your charitable contribution deduction is generally capped at 10% of your taxable income.
10% of taxable income.
Okay.
But how is that taxable income calculated for this purpose? Is it just the bottom line?
Not quite. It's a specific calculation. You compute your taxable income without considering the deduction for the charitable contributions themselves. You also calculate it without certain special deductions, like the dividends received deduction we'll talk about later, without certain bond premium limitations, without any net operating loss, NOL, carrybacks, carryforwards are different, and without any capital loss carrybacks.
Okay, so it's a modified taxable income figure, likely a bit higher than the final number.
Often, yes, which gives you a slightly larger base for that 10% limit. Now, if your charitable contributions for the year exceed this 10% limitation, you obviously cannot deduct that excess amount in the current year.
So you lose the deduction for the excess.
No, not necessarily. And this is the crucial tax benefit. The unused portion, the amount over the 10% limit, can be carried over and deducted for the next 5 tax years.
A 5-year carryover. That's valuable.
Extremely valuable. It means a particularly generous year of corporate giving can continue to provide tax benefits well into the future. It smooths things out and acts as a really good long-term tax planning tool for philanthropy.
Excellent point. Okay, beyond those strategic elections like startup costs and charitable timing, what about the more day-to-day operational expenses? Let's dig into those, starting with employee-related deductions. These must be a huge chunk of expenses for many companies and potentially big savings.
Oh, employee-related deductions are indeed a major area, absolutely. Contributions your corporation makes to qualified plans, think pension plans, profit-sharing plans, 401ks, other funded deferred compensation plans. Those contributions are generally fully deductible, within certain limits, of course.
So this isn't just about providing benefits, it's a direct tax deduction for the company.
Precisely. It's a powerful mechanism for the corporation to both reward employees and defer or reduce its own taxable income. It's important to remember, though, that most employers sponsoring these types of plans generally must file informational returns each year, like the Form 5500 series.
Even if they don't claim a deduction that year.
Yes, usually even if no deduction is claimed for the current year, the filing is still required. And there are penalties for failing to file those forms on time or for overstating the deduction claimed on the tax return. So compliance is key here, too.
What about other employee benefits, like health insurance?
Right. Contributions to other employee benefit programs, things like insurance premiums for health, life, accident plans, or other health and welfare programs that aren't considered an incidental part of a pension plan, those are also generally fully deductible. They'd often fall under line 24, employee benefit programs.
Okay. And I remember seeing something specific about dividends paid on ESOP stock. That sounded interesting.
It is quite specific, but potentially very valuable for companies with employee stock ownership plans, or ESOPs. Under certain circumstances laid out in Section 404K of the tax code, dividends paid in cash on stock held by an ESOP can actually be deductible by the corporation.
Deductible dividends. How?
It applies if the dividends are paid directly to the plan participants or their beneficiaries, or if they're paid to the plan and then distributed to participants within 90 days of the end of the plan year. Or, and this is common, if the dividends are used by the ESOP to make payments on a loan that was used to acquire the employer's stock held in the ESOP.
Using dividends to pay off the ESOP loan.
Exactly. It's a very particular provision, but for companies that have ESOPs, especially leveraged ESOPs, it's a significant deduction opportunity, effectively making part of the loan repayment tax deductible.
Fascinating. Okay, let's move to other common general business expenses. What about interest paid on loans or bonds, or taxes paid to state and local governments? These are everyday costs for almost any business.
They certainly are. Interest expense that your corporation incurs is generally deductible. This includes interest on things like U.S. government obligations, business loans, notes, mortgages, corporate bonds, even interest paid on bank deposits or interest the IRS might pay you on a tax refund, though that interest received is also income.
Okay, seems straightforward. Any catches?
Oh, yes. There's a major limitation to be aware of now, the limitation on business interest expense under Section 163. This came in with the Tax Cuts and Jobs Act.
Right, 163J. How does that work?
For many corporations, the deduction for business interest expense is generally limited each year. The limit is basically the sum of three things: your business interest income for the year, plus 30% of your adjusted taxable income, ATI, plus any floor plan financing interest, which mainly applies to vehicle dealers.
30% of ATI. How's ATI calculated?
Adjusted taxable income, or ATI, is roughly similar to EBITDA, earnings before interest, taxes, depreciation, and amortization, but the exact calculation can be complex and has changed over time. The key point is there's a cap. If this limitation applies to your corporation, and for many it does, you must file Form 8990, Limitation on Business Interest Expense under Section 163J.
Okay, Form 8990. And what happens to the interest you can't deduct because of the limit?
Good news, any business interest expense that's disallowed in the current year because of the 163J limit isn't lost forever. It can be carried forward indefinitely to the following tax years and potentially deducted then, subject to the limit in those future years.
Okay, so it's deferred, not lost.
Correct. But the rule is definitely designed to prevent corporations from using excessive interest deductions to significantly erode their tax base. It requires careful monitoring and calculation.
Definitely sounds like it. Now, what about taxes? You pay taxes to the government, but can the taxes you pay be deductible? It feels a bit circular.
It does sound a bit strange, but yes, certain taxes and licenses paid or accrued during the tax year are generally deductible as a business expense.
Which ones?
This can include things like state and local income taxes imposed on the corporation, real property taxes on business property, personal property taxes, the employer's share of employment taxes like Social Security and Medicare, federal unemployment tax, FUTA, and various state and local business licenses or regulatory fees.
Okay, quite a few. What's not deductible then?
The exclusions are crucial. You absolutely cannot deduct federal income taxes. That's rule number one.
Makes sense. You can't deduct the tax you're calculating on the return itself.
Right. You also generally can't deduct foreign or U.S. territory income taxes if you're choosing to claim a foreign tax credit for those taxes instead. You have to pick one: deduction or credit. Usually the credit is better, but not always.
Okay, deduction or credit, not both.
Correct. Also, taxes that aren't actually imposed on your corporation aren't deductible by it. And taxes you might pay as part of acquiring or disposing of property, like transfer taxes on real estate, those are generally not deducted immediately. Instead, they're added to the cost basis of the property acquired, or they reduce the amount realized on the disposition.
So they affect gain or loss later, not deducted now.
Exactly.
Okay.
And one last common one: taxes assessed against local benefits that tend to increase the value of your property. Think assessments for new street paving, sidewalks, or sewer lines in front of your building. Those are generally considered capital improvements and aren't deductible as taxes.
Okay, so while you're paying a whole variety of taxes and fees throughout the year, only certain types actually reduce your taxable income on Form 1120. A subtle but important planning point.
Very much so. You need to track them carefully.
What about common operating costs like repairs and maintenance? Or, unfortunately, bad debts when customers don't pay?
Repairs and maintenance expenses are deductible, definitely, but only to the extent they relate to your trade or business activity. Personal use portions wouldn't be.
Right.
Corporations also have an interesting election related to repairs. Under the tangible property regulations, you can sometimes elect to capitalize certain repair and maintenance costs if that's consistent with how you treat them in your books and records. This might be useful for smoothing out income over time, perhaps.
Okay, an option to capitalize repairs.
Yeah.
Interesting. And bad debts.
For bad debts, you can generally deduct the total amount of debts owed to you that became worthless, either in whole or in part during the tax year. You have to be able to show they actually became worthless in that year.
Makes sense. Any catches?
Yes, a critical one, especially for cash method corporations, though we said most larger ones are accrual. If you're on the cash method, you generally cannot claim a bad debt deduction unless the amount you're writing off was previously included in your income.
Ah, so if you never recorded the income because the customer didn't pay, you can't then take a deduction for not receiving it.
Exactly. You can't get a deduction for something you never counted as income in the first place. Accrual basis taxpayers usually don't have this issue because they would have already recognized the income when the sale was made.
Got it. What about depreciation? That's usually a big one.
Huge. Depreciation allows you to recover the cost of your tangible assets, buildings, machinery, equipment, furniture, vehicles, over their useful lives. It's claimed on Form 4562, and the total flows to Form 1120.
Are there any specific limits mentioned in the 1120 instructions?
They do highlight the depreciation limits for vehicles, especially luxury automobiles. For cars, specifically excluding trucks and vans, placed in service after December 31st, 2023, but before January 1st, 2025, the total depreciation deduction you can claim, including any Section 179 expensing, is capped. For 2024, that first-year limit is actually quite high due to bonus depreciation rules, but the instructions specifically mention the inclusion amount rules that can apply to leased vehicles, and they point you to the relevant publications for the specific dollar limits on depreciation for purchased vehicles, which change annually. The instructions themselves gave an example limit from a prior year, but directed users to current pubs for the 2024 limits. Let's say, hypothetically, a limit was around $20,200 for the first-year base limit before bonus, or $62,000 for certain trucks fans. You'd need to check the current Form 4562 instructions for the exact 2024 amounts.
Okay, so check the specific limits for vehicles each year. Good point. And there's that specific deduction for energy-efficient commercial buildings. That sounds like a great incentive for businesses looking to go green and potentially save on taxes.
Indeed. The Section 179D energy-efficient commercial buildings deduction is a significant opportunity. It provides a deduction for businesses that make qualifying investments in new or existing commercial buildings to improve energy efficiency. Think upgrades to lighting, HVAC, or the building envelope.
How do you claim that?
You claim this deduction by completing and attaching Form 7205, Energy Efficient Commercial Buildings Deduction. There are specific energy-saving targets you need to meet, often requiring certification by an engineer or contractor. But the potential deduction can be substantial, making green upgrades more financially attractive.
Definitely worth looking into. And then there's that catch-all line, other deductions. What typically goes there?
Right, line 26. This is essentially for all your other ordinary and necessary business expenses that aren't specifically listed on their own lines elsewhere on the return.
Like what? Give us some examples.
Oh, it's a wide range. Think insurance premiums, business liability, property insurance, etc., legal and professional fees like your accountant's bill for preparing this very return, or lawyer's fees for business matters, office supplies, utilities, if not included elsewhere, advertising and marketing costs.
Travel and meals might end up here too, right? Or parts of them?
Parts of them might, or they might be netted elsewhere, depending on how you track them. But yes, the deductible portion of business meals often lands here. Also, things like bank service charges, dues, and subscriptions, the deductible kind, maybe ordinary losses from a partnership your corporation invests in. It's a broad category, but these expenses often add up significantly, so meticulous tracking throughout the year is key to maximizing this deduction.
Absolutely. Okay, here's where things often get, let's say, tricky. Some very common business expenses have incredibly specific, sometimes even surprising, rules about whether you can deduct them or how much. Let's talk about navigating travel, meals, and entertainment. These seem like areas ripe for misunderstanding and potential lost savings, or worse, disallowed deductions.
This is absolutely one of the most common areas where businesses make mistakes, often inadvertently. And disallowed expenses found during an audit can be painful. Let's start with travel expenses.
Okay, business trips.
The rule about bringing someone along on a business trip is quite strict. Your corporation cannot deduct the travel expenses, airfare, hotel, meals, for any individual who accompanies a corporate officer or employee on a trip unless that accompanying individual meets two conditions.
What are they?
One, that individual must also be an employee of the corporation. Two, their travel must be for a bona fide business purpose of their own, and those travel expenses would otherwise be deductible by that individual personally if they had paid them.
So bringing your spouse along just for company, generally not deductible for the spouse's costs.
Generally, no, unless the spouse is also a legitimate employee traveling for their own necessary business reasons on that same trip. It's a high bar.
Okay.
Yeah.
Good to clarify.
Yeah.
Now, meals. The rules here seem to change every few years. What's the current landscape for deducting business meals?
You're right, they have fluctuated. Currently, for business meals that are not considered entertainment, the general rule is that only 50% of the amount otherwise allowable is deductible.
Only 50% deductible. Still better than nothing, I guess.
Right, but there are key requirements even for that 50%. The meals must not be lavish or extravagant under the circumstances.
Subjective, but okay.
A bit, yes. And an employee of the corporation or the business owner, if it's a sole prop or partnership, but here we're talking corporations must be present when the food or beverages are furnished.
Okay, employee has to be there.
Yes. And crucially, if meal expenses are not stated separately from entertainment expenses on an invoice or receipt.
Like dinner and a show, all on one bill.
Exactly. If they're not broken out, the entire expense might be treated as non-deductible entertainment. So getting separate receipts or itemized bills is really important if you want to claim that 50% meal deduction.
Good practical tip. Now, what about those employee perks, like qualified transportation fringes? Things like providing transit passes or paying for employee parking near the office. Many businesses offer these. Are they deductible?
This is a critical point and one that often surprises employers because the rules changed significantly a few years back. Generally, under Section 274, A04, no deduction is allowed for expenses related to qualified transportation fringes, or QTFs, provided by employers to their employees.
No deduction at all, even though it's a benefit for the employee.
Correct. No deduction for the employer. This includes providing transportation in a commuter highway vehicle like a van pool, providing transit passes, or providing or paying for qualified parking for employees.
Oh.
While these are often valuable, non-taxable benefits to the employee, the corporation itself typically doesn't get a tax deduction for the cost of providing them.
Wow, that's a key area where businesses could easily assume deductibility and be wrong. Yeah. That's a direct hit to the bottom line if they thought they could deduct it.
It really is. It leads to disallowed expenses and unnecessary tax if you're not aware of that rule.
Okay. What about membership dues? Especially for clubs. I feel like country club dues are the classic example of something you can't deduct. Is that still the case?
Yes, that stereotype holds true, largely. The rules differentiate between types of organizations. Membership dues paid to civic or public service organizations like Rotary Club, professional organizations like bar associations or medical associations, business leagues, trade associations, chambers of commerce. Those are generally deductible.
Why those?
Because they're generally viewed as ordinary and necessary for professional development, networking, staying current in your field, things like that.
Makes sense. So what's not deductible?
The IRS is very clear here. No deduction is allowed for membership dues paid to any club organized for business, pleasure, recreation, or other social purposes.
Okay, so that covers?
Explicitly, this includes country clubs, golf and athletic clubs, airline clubs, hotel clubs, and any club whose main purpose is providing meals or lodging under conditions generally considered conducive to business discussions, even if you do talk business there. The type of club matters more than how you use it.
Got it. No deduction for those social or recreational clubs. What about the facilities themselves, like owning a company yacht or a hunting lodge used for entertaining clients?
Similar rule. Generally, no deduction is allowed for an expense paid or incurred for owning or maintaining a facility, like a yacht, hunting lodge, fishing camp, swimming pool, tennis court, etc., that is used in connection with an activity usually considered entertainment, amusement, or recreation.
So even if used for business entertainment, the cost of the facility itself is generally out.
Generally out, yes. The direct costs of qualified business meals at the facility might be 50% deductible, subject to the rules we discussed, but not the depreciation, upkeep, etc. of the facility itself if it's primarily an entertainment facility.
Okay, these entertainment and club rules seem pretty strict. But I think you mentioned an important exception earlier, something about treating otherwise non-deductible entertainment or recreation expenses as compensation to the recipient. That sounded like a potential pathway to deductibility, but needing careful reporting.
Precisely. This is a critical exception, the compensation exception. If an expense for entertainment, amusement, or recreation would normally be non-deductible under the rules we just discussed, it can become deductible if the amount is treated as compensation to the person who received the benefit.
How does that work?
It has to be properly reported. If the recipient is an employee, the amount must be treated as wages and reported on their Form W-2. If the recipient is an independent contractor, it must be treated as non-employee compensation and reported on Form 1099 NEC.
So if the company pays for, say, an employee's non-deductible club dues, but includes that amount in their W-2 income,
Then the corporation can deduct that amount as compensation expense. There are some special, more restrictive rules if the recipient is an officer, director, a 10% or more beneficial owner, or certain other specified individuals, but the core principle holds. If it becomes taxable income to them and is reported correctly, it can be a deductible expense for the corporation.
that's a very important distinction. Proper reporting is key to unlocking that deduction.
Absolutely. It shifts the nature of the expense from potentially non-deductible entertainment to deductible compensation.
Okay. Beyond these nuanced categories like meals and entertainment, what are some other crucial non-deductibles that businesses should absolutely avoid, or at least understand they get no tax benefit from? Avoiding these could be a saving in itself by not incurring pointless costs. You mentioned fines and penalties earlier. Feels like a clear message from the IRS. Don't expect a tax break for breaking the law.
That's a strong and accurate summary of the IRS's stance. First and foremost, generally no deduction is allowed for fines or similar penalties paid or incurred to or at the direction of a government or governmental entity for the violation of any law.
Any law, so even minor infractions.
The rule is broad. It also includes amounts paid for an investigation into a potential violation of law. The IRS is very firm. You don't get a tax subsidy for wrongdoing or for the costs of being investigated for it.
Are there any exceptions? What about restitution?
There are very limited exceptions laid out in the statute. A deduction might be allowed if the payment constitutes restitution for damage or harm caused by the violation, or if it's paid to come into compliance with the law. Amounts paid related to orders or agreements in lawsuits where no government entity is a party might also be deductible. And payments for taxes due are generally deductible if the underlying tax itself is deductible, like state income tax.
But payments to the government for the investigation.
Explicitly not eligible for the exceptions. Any amounts paid or incurred as reimbursement to the government for its investigation costs or litigation costs are non-deductible. So the cost of breaking the law and the cost of getting caught generally hit your bottom line with absolutely no tax relief.
Crystal clear. What about lobbying expenses? Businesses often engage with lawmakers. Are those costs deductible?
Lobbying expenses are also generally not deductible. This covers amounts paid or incurred in connection with influencing legislation at the federal, state, or even local level.
Influencing legislation, like trying to get a law passed or stopped.
Exactly. It also includes costs related to communicating directly with certain high-level federal executive branch officials in an attempt to influence their official actions or positions.
Okay. Any exceptions at all here?
There's a very narrow de minimis exception for in-house lobbying expenditures. If a corporation's total in-house lobbying costs for the year do not exceed $2,000, excluding payments to professional lobbyists or dues attributable to lobbying, then those costs can be deducted. But beyond that small threshold, the general rule of non-deductibility applies. You can't deduct the cost of trying to sway government policy.
Got it. And finally, I recall a specific rule about transactions between related taxpayers, especially for accrual basis companies. Something about timing to prevent artificial deductions.
Yes, this is an important anti-abuse rule under Section 267. It's designed to prevent timing games between related parties like a corporation and its controlling shareholder, or two corporations under common control.
How does it work?
If you're an accrual basis taxpayer, you generally cannot deduct business expenses or interest owed to a related party who is on the cash basis until the year that the payment is actually made and therefore included in the income of that related cash basis party.
So the deduction is deferred until the related party picks it up as income.
Exactly. It forces a matching of the deduction and the income recognition between related parties. This prevents scenarios where the accrual basis company takes a deduction in year one, but the related cash basis party doesn't report the income until they actually receive the cash in year two or later. It ensures fairness and prevents artificial income deferral or expense acceleration within related groups.
Makes sense. Keeps everyone on the same timetable tax-wise.
Pretty much.
Okay, so we've covered a lot about expenses going out and whether they can be deducted. But what happens when things go the other way? When your income doesn't quite cover those expenses or your business maybe takes a significant hit and has a big loss for the year, that's where net operating losses or NOLs come into play, right? And managing these seems like a critical strategic decision that can really impact long-term tax planning and cash flow, especially for businesses with profits that swing up and down.
The strategic power of net operating losses, or NOLs, for a corporation really cannot be overstated. They are a crucial tool. If your taxable income, calculated on line 30 of Form 1120, but figured without certain adjustments like the NOL deduction itself comes out to zero or less, your corporation may very well have an NOL.
And this isn't just, bad news on paper. It's actually a tax asset.
Exactly. It's not just a paper loss, it's a valuable tax asset. These NOLs can then be carried either back to past profitable years, though this is now restricted for most NOLs, or, more commonly now, carried forward to future tax years to reduce your taxable income in those future profitable years.
So you're basically using a loss from a bad year to offset profits from good years.
That's the essence of it. You're reducing your tax liability in those other more profitable years, effectively getting a tax benefit from the loss year.
How does this carry back or carry forward mechanism work now? I know the rules changed significantly a few years ago.
They did with the Tax Cuts and Jobs Act and then tweaked again later. For NOLs that arise in tax years beginning after December 31st, 2017, the rules are quite different than they used to be. First, carrybacks are generally eliminated for most corporations.
No more carrying back losses to get quick refunds from past taxes paid.
Generally, no. There are exceptions for certain farming losses and for insurance companies, other than life insurance companies. But for most regular C-Corp, NOLs arising after 2017 can only be carried forward.
Okay, carry forward only. Indefinitely.
Yes, the good news is they can generally be carried forward indefinitely. There's no longer a 20-year limit like there used to be.
Okay, that's helpful. But isn't there a limit on how much of an NOL you can use in any given future year?
Yes, that's the other big change. The aggregate amount of these post-2017 NOLs that you can carry forward and deduct in a particular future tax year is generally limited. The limit is 80% of your taxable income for that future year.
80%. So you can't wipe out all your taxable income with NOL carry forwards.
Generally, no. You can reduce it significantly, but usually not below 20% of what it would have been without the NOL deduction. This taxable income for the 80% limit calculation is computed without taking into account the NOL deduction itself or the Section 199A deduction, if applicable, though less common for C-Corp, or the Section 250 deduction for certain foreign-derived income, FDII, JILTI.
Okay, 80% limitation. That's a major planning point.
It is. It means even with large NOL carryforwards, corporations might still have some tax liability in profitable years. Again, there's an exception to this 80% limit for NOLs of insurance companies other than life insurance companies.
Now, even though carrybacks are mostly gone, what if a corporation could carry back, like a farming loss?
Yeah.
Or, more relevantly, what if they just want to commit to only carrying forward? Is there an election for that?
Yes. Even when a carryback might be permitted, or for older NOLs where it was the default, corporations generally have the option to waive the entire carryback period for an NOL. If you waive the carryback, you commit to only carrying the NOL forward to future tax years.
How do you make that choice?
This election is typically made by checking a specific box on the tax return for the year the NOL arises. On Form 1120, it's usually a checkbox on Schedule K, line 11. You have to make the selection by the due date, including extensions, for filing the tax return for that loss year.
And once you make it, can you change your mind?
Generally, no. Once the selection to waive the carryback is made, it is irrevocable for that specific NOL.
So it's a critical strategic decision.
Absolutely. Do you want to potentially amend past returns to get a refund now, if a carryback is even allowed? Or do you want to preserve that entire loss to offset potentially higher future profits? For businesses expecting growth, carrying forward is often very appealing, especially now that it's indefinite. It significantly impacts long-term tax planning and cash flow projections.
Definitely a lot to consider there with NOLs. Okay, this next topic is fascinating and often misunderstood, I think. It relates to how corporations handle dividends they receive from other corporations. How do they avoid getting taxed multiple times on the same underlying corporate profit? This is where the dividends received deduction, or DRD, comes in, right? Found on Schedule C of Form 1120. Sounds complex, but potentially huge for savings in corporate groups.
You've nailed it. The dividends received deduction, or DRD, primarily governed by Section 243 of the tax code, is truly a cornerstone of corporate tax efficiency, especially within groups of companies. Its core concept is exactly what you said, to prevent the same corporate income from being subjected to multiple layers of corporate-level taxation as it flows up a chain of corporations in the form of dividends.
So it stops that income getting taxed, say, at the subsidiary level, and then again when the subsidiary pays a dividend to the parent corp.
Precisely. Without the DRD, a subsidiary's profits would be taxed. Then, when it pays a dividend to its corporate parent, that dividend could be taxed again at the parent level. Then, if the parent eventually pays a dividend to its individual shareholders, it gets taxed a third time there. The DRD is designed to largely mitigate that middle layer, that corporate-to-corporate double tax, promoting capital efficiency and making corporate structures more sensible from a tax perspective.
Okay, that makes perfect sense. Now, I understand the percentage of the dividend you can deduct varies significantly based on how much stock your corporation owns in the corporation paying the dividend. This sounds like a clear incentive for owning more.
Absolutely. The ownership percentage is the key driver here, determining the DRD rate. There are basically three main tiers for dividends from domestic corporations subject to U.S. tax.
Tier 1.
If your corporation receives dividends from a domestic corporation where you own less than 20% of its stock by vote and value, you typically qualify for a 50% deduction. So half of those dividends are effectively received tax-free by your corporation.
Okay, 50% for less than 20% ownership. Tier 2.
If your corporation owns 20% or more, but less than 80% of the domestic corporation paying the dividend, that deduction jumps significantly to 65%.
So crossing that 20% threshold gives you a bigger tax break.
Definitely. It's a clear incentive from the tax code for more substantial ownership stakes, but it gets even better.
Tier 3.
Tier 3 is the 100% deduction. This generally applies in two main scenarios. First, for dividends received from members of the same affiliated group, think parent-subsidiary structures where there's at least 80% ownership, provided the group elects this treatment or doesn't file a consolidated return where intercompany dividends are eliminated anyway.
So within a tightly controlled group, dividends can move tax-free between the corporations.
Essentially, yes, the DRD eliminates the tax friction. The second scenario for 100% DRD is for certain dividends received from wholly owned foreign subsidiaries, which we can touch on. But the key takeaway is owning more, especially reaching that 20% or affiliated group threshold, leads to significantly higher tax efficiency for intercorporate dividends.
That's very clear. You mentioned wholly owned foreign subsidiaries. Do similar 100% benefits apply there? How does the DRD work for dividends coming from outside the U.S.?
It's more complex for foreign dividends, but yes, there is a specific 100% deduction available under Section 245B for dividends received from certain wholly owned foreign subsidiaries.
Are there the conditions?
It applies if the dividend is paid out of the foreign subsidiary's earnings and profits from a tax year during which all of its outstanding stock was directly or indirectly owned by the domestic corporation receiving the dividends. And crucially, all of that foreign subsidiary's gross income from all sources during that year must have been effectively connected with a U.S. trade or business.
So the foreign subsidiary has to be basically operating and paying tax like a U.S. business already.
Essentially, yes. If those conditions are met, the dividend can come back to the U.S. parent with a 100% DRD, again avoiding multiple layers of tax within that integrated international corporate group.
Okay. Are there any other special considerations or limitations on the DRD we should know about? For instance, what if a corporation borrows money specifically to buy the stock that's going to pay these dividends? That sounds like it could be used just to generate a tax deduction.
You're right to flag that potential for abuse, and the IRS is ahead of you. There are specific limitations to prevent using debt purely to create artificial tax advantages through the DRD. Under Section 246A, if the stock that's paying the dividends was acquired by incurring debt, you borrowed money specifically to purchase that stock, then your 50% or 65% DRD is reduced.
Reduced how?
The reduction is based on a percentage related to the amount of portfolio indebtedness attributable to that stock. Basically, the portion of the dividend considered financed by debt doesn't get the full DRD benefit. This prevents a simple arbitrage where you borrow, deduct the interest, and also get a full DRD on the dividends funded by the borrowing.
Makes sense. Any other specific types of stock with different DRD rules?
Yes, there are special lower deduction percentages for dividends received on certain preferred stock of public utilities issued before a certain date. The percentages are quite specific, like 23.3% or 26.7%, depending on ownership. It's a bit of a historical artifact, but the rules are still there in the instructions.
Good to know. How does the DRD interact with dividends from foreign corporations more generally, beyond that wholly owned subsidiary rule we discussed? Can you get a DRD for dividends from, say, a 30% owned foreign company?
The rules for foreign dividends are definitely more complex than for domestic ones. Generally, for the regular 50% or 65% DRD, it only applies to the U.S. source portion of dividends received from foreign corporations.
The U.S. source portion.
Right. And even then, there are ownership thresholds. You might qualify for a 50% deduction on the U.S. source portion from a less than 20% owned foreign corporation, but only if your corporation owns at least 10% of its stock by vote and value. This increases to a potential 65% deduction on the U.S. source portion from a 20% or more owned foreign corporation.
Okay, so it's possible but limited and depends on U.S. sourcing. What about that other deduction you mentioned, Section 245A?
Section 245A is different. That was a major part of the international tax changes in 2017. It generally allows a 100% deduction for the foreign source portion of dividends received from certain specified 10% owned foreign corporations. This is essentially the mechanism for the U.S.'s move towards a territorial system for certain foreign earnings repatriated as dividends.
So 245A covers the foreign part, while the regular DRD might cover the U.S. part.
It's more complicated than that, and they interact, but that's the general idea. Crucially, though, foreign source dividends that do not qualify for the Section 245A deduction, for example, certain hybrid dividends or dividends that fail specific holding period requirements must be reported separately and are not eligible for the general 50% or 65% dividends received deduction either.
Wow, okay. International dividends sound like a minefield requiring careful analysis.
They really are. You also have specific rules for dividends from former foreign sales corporations, FSCs. The key takeaway is don't assume the DRD applies easily to foreign dividends. The rules are very intricate.
Understood. Now, there's one more interaction you hinted at earlier, the DRD and net operating losses. You said the DRD can be even more powerful when a company has a loss. How does that work? That sounds like it could amplify the tax benefit in a down year.
This is a particularly strategic point, especially for corporations with volatile earnings. In a year where your corporation incurs a net operating loss, NOL, certain limitations that normally apply to the dividends received deduction specifically, a limitation based on taxable income found in Section 246B1, do not apply.
So the normal income limitation on the DRD goes away if you have an overall loss.
Exactly. And this holds true even if the NOL is actually created or made larger by taking the full DRD itself. So let's say your company has operating income, but receives a large amount of dividends eligible for the 65% DRD. Taking that full DRD might push the company into an overall NOL position. In that case, the taxable income limitation that might otherwise have reduced the DRD doesn't apply.
So the DRD gets its full potential benefit even if it contributes to the loss.
Right. It can provide an even greater tax shield against any dividend income you receive during a challenging year, potentially enhancing the overall tax benefit generated in that loss year. It's a provision that can definitely amplify savings during tough economic times.
That's a fantastic nugget. Okay, so to round out the DRD, understanding what doesn't qualify is just as important as knowing what does, right?
Yeah.
To avoid common mistakes and not claim a deduction you're not entitled to. What are some common types of payments that might look like dividends but are excluded from the DRD?
That's a critical distinction, absolutely. Many things might be labeled dividends but don't qualify for the DRD. First, any payments received from mutual savings banks, even if called dividends or earnings, are generally treated as interest for tax purposes, not dividends eligible for the DRD.
Okay, mutual savings banks interest.
Right. Similarly, dividends from an ICDSE, that's Special Export Incentive Corporation, generally not eligible for the DRD if they're paid out of certain types of DC income or are deemed distributions because those already get special tax treatment.
Got it. What about REITs and REITs?
This is a big one. Dividends received from regulated investment companies, AXIs, basically mutual funds or real estate investment trusts, REITs, generally do not qualify for the DRD. There's an exception for certain capital gain distributions, but ordinary dividends from REITs and REITs are out.
Why is that?
Because REITs and REITs themselves generally get a deduction for the dividends they pay out to their shareholders. Allowing a corporate shareholder to also get a DRD would be an unintended double benefit. So the deduction is typically only allowed at the REIT level.
Okay, no double dipping. Makes sense. Other exclusions.
Dividends from tax-exempt organizations are excluded, and there's a rule against getting the DRD if your corporation holds the stock but is simultaneously under an obligation, for example, through a short sale to make related payments on substantially similar or related property. That prevents artificial DRD creation through hedging strategies. Understanding these exclusions is just as vital as knowing the deduction rules themselves, avoids common pitfalls.
Excellent summary. Okay, we've navigated deductions, which lower your taxable income, but now let's get to the part that often feels even better, maybe the real icing on the cake. Tax credits. You said earlier these are even more powerful because they're a dollar-for-dollar reduction of your actual tax liability, like getting a direct discount, not just a coupon. What specific credits should corporations be actively looking for to directly slash their tax bill?
That analogy is perfect. Credits directly reduce your tax bill, making them incredibly valuable. A $1,000 credit saves you $1,000 in tax, period. A $1,000 deduction can only save you $210 if your tax rate is 21%. So yeah, credits provide much more bang for your buck.
So where do we find these powerful credits?
Generally, corporate credits are reported on Schedule J of Form 1120, and they broadly fall into two categories: non-refundable and refundable. Non-refundable credits are great. They can reduce your tax liability all the way down to zero.
But they won't give you money back if you owe nothing.
Exactly. They can eliminate your tax, but they won't result in a refund if your tax liability is already zero or less.
Okay, so what are some of the most significant non-refundable credits corporations should be investigating?
One of the most important, especially for companies with international operations, is the foreign tax credit. This is claimed on Form 1118. As we touched on with deductions, this credit allows you to reduce your U.S. tax liability for income taxes you've already paid to a foreign country or a U.S. territory on the same income. It's the primary mechanism to prevent double taxation.
Crucial for global businesses.
Absolutely. But perhaps the biggest category for domestic credits is the general business credit, or GBC. This isn't just one credit. It's actually an umbrella credit reported on Form 3800 that aggregates dozens of individual business credits together.
Dozens, wow. So Form 3800 is like a clearinghouse for credits.
Exactly. You calculate each individual credit you qualify for on its own specific form, and then they all flow onto Form 3800, where an overall limitation based on your tax liability is applied. It's a composite credit offering numerous ways to directly lower your tax. Think of it as a master key unlocking many different tax-saving opportunities.
Okay, that sounds powerful. Can you give us some examples of the specific, impactful general business credits hidden under that umbrella? What should corporate leaders be looking for here? This seems like where real savings can be found, often by doing things the government wants to incentivize anyway.
There's a huge variety, really encouraging all sorts of positive business activities. For instance, a very popular one is the Work Opportunity Credit, or WOTC. Right. Claimed on Form 5884. This credit incentivizes employers to hire individuals from certain targeted groups who traditionally face significant barriers to employment. Think qualified veterans, ex-felons, long-term unemployment recipients, SNAP recipients, etc. You get a credit for hiring and retaining these folks. It's a real win-win.
Great for social impact and the bottom line. What else?
A huge one, especially for innovative companies, is the credit for increasing research activities, better known as the R&D credit, claimed on Form 6765. This directly rewards companies, dollar for dollar in some cases, for qualified spending on research and development activities conducted within the U.S.
And this isn't just for giant tech or pharma companies, right?
Absolutely not. That's a common misconception. Many smaller businesses overlook this. It can apply to developing new products, improving existing ones, developing new processes, software development, even certain types of internal experimentation. If you're trying to make things better, faster, cheaper, greener through technological R&D, you should definitely investigate this credit. It can be incredibly valuable.
Okay, R&D credit, big potential. What are some others under the GBC?
Well, there are more specialized ones, like the Orphan Drug Credit, Form 8820, supporting development of drugs for rare diseases. There's the Disabled Access Credit, Form 8826, which helps eligible small businesses cover costs of making their facilities accessible to people with disabilities, things like installing ramps or modifying equipment.
Good for accessibility.
Yes. And the Empowerment Zone Employment Credit, Form 8844, which encourages hiring residents of and investing in designated distressed communities.
What about credits related specifically to employee benefits or payroll taxes? Those seem like they could directly offset labor costs.
Definitely. For businesses in the service industry, especially restaurants and bars with tipped employees, there's the credit for employer Social Security and Medicare taxes paid on certain employee tips. It's claimed on Form 8846. It's basically a credit for the employer's share of FICA taxes paid on tips that are above the federal minimum wage.
Ah, interesting niche credit.
It can be significant for those industries. And for smaller businesses looking to enhance benefits, there are two fantastic GBC opportunities. First, the credit for small employer pension plan startup costs, Form 8881. This helps offset the administrative costs of setting up a new 401k, simple IRA, or other qualified retirement plan for employees. Makes it much cheaper to start offering a plan.
Lowering the barrier to entry for retirement plans. Great.
Exactly. And second, the credit for employer-provided childcare facilities and services, Form 8082. This provides a credit for qualified expenditures related to acquiring, constructing, or operating an on-site childcare facility for employees, or for paying for off-site childcare services for them.
Wow, that sounds amazing.
Wow.
Supporting employees' childcare needs and getting a tax credit.
It is. It's a prime example of how tax policy can encourage practices that benefit both a company's workforce and its tax bill. Really powerful when you can align those.
Absolutely. Any other notable general business credits we should quickly mention?
Just a few more examples to show the breadth. The low sulfur diesel fuel production credit, Form 8896, for producing qualifying fuel. The credit for employer differential wage payments, Form 8932, for employers who continue to pay wages to employees called up for active military duty. The credit for small employer health insurance premiums, Form 8941, which helps eligible small employers, generally fewer than 25 full-time equivalent employees with average wages below a certain amount, afford to offer health insurance. And the employer credit for paid family and medical leave, Form 8994, which encourages employers to provide qualifying paid leave under specific conditions.
Okay, that's a lot under the general business credit umbrella. Form 3800 is key. Are there other non-refundable credits outside the GBC?
Yes, a couple of others often seen on Schedule J. There's the credit for prior year minimum tax, claimed on Form 8827. This allows corporations to recover alternative minimum tax, AMT, paid in prior years, now that the corporate AMT has been repealed, though a new CMT exists for very large core. And there are bond credits reported on Form 8912 for holders of certain types of tax credit bonds issued by state or local governments. So the landscape of non-refundable credits is vast, and diligent exploration based on your company's specific activities can really unlock substantial tax reductions.
Definitely sounds like it's worth the effort to investigate all potential credits. Okay, now let's talk about the real gems, as you call them, refundable credits. These are the ones that can actually result in cash back from the IRS, even if your tax liability is already zero. This feels like found money, directly boosting cash flow.
These are indeed the most immediately impactful for cash flow, you're right. If a refundable credit amount exceeds your total tax liability for the year, the IRS doesn't just wipe out the tax, they actually send you a check, a refund for the difference.
So what are the main refundable credits corporations might encounter?
One key refundable credit comes from information reported on Form 2439, Notice to Shareholder of Undistributed Long-Term Capital Gains. This credit is for your corporation's share of the tax that was already paid by a regulated investment company, a IC, like a mutual fund, or a real estate investment trust, a REIT, on undistributed long-term capital gains that they allocated to you and you had to include in your corporation's income.
So the IIC or REIT paid the tax, but passed the income through.
Exactly. Since the tax was paid at the fund level on income you had to report, Form 2439 allows you, the corporate shareholder, to claim a credit, essentially a refund for that tax already paid on your behalf.
Got it. Prevents double payment. What else?
There's also the credit for federal tax on fuels, claimed on Form 41336. This is generally for refunding federal excise taxes paid on certain fuels, like gasoline or diesel, when those fuels were used for specific qualifying purposes, like off-highway business use, example in construction equipment or generators, or in farming operations. If you paid tax at the pump but used the fuel in a non-taxable way, this form gets you that tax back.
Okay, for specific fuel uses.
Right. And perhaps the most relevant refundable credit for businesses with international dealings or certain types of investments is the credit for tax withheld under Chapter 3 or 4 of the Internal Revenue Code.
That sounds technical. What does it cover? This seems crucial for preventing double taxation on international income and directly impacting cash flow.
It is technical, but hugely important. This credit applies to U.S. tax that has been withheld at the source on certain types of income paid to your corporation. This would be tax withheld on U.S. source income paid to foreign persons, reported on Form Known 42S if your core is acting as the foreign person in certain structures, or tax withheld from a foreign partner's share and effectively connected income, reported on Form 8805, or withholding tax related to dispositions by foreign persons of U.S. real property interests, reported on Form 8288A.
So it's basically getting credit for U.S. tax that someone else already paid or withheld on your behalf.
Exactly. Since the tax was already taken out before you even received the income or paid on your behalf by a partnership, this credit allows you to claim that withheld amount back as a payment against your total tax liability. If the withheld amount exceeds your tax liability, you get a refund. It's a direct recovery of cash already withheld, preventing double taxation and preserving your working capital. Very important for those dealing with these types of income streams.
Absolutely critical. Okay, so maximizing deductions and credits is huge for tax savings. But the flip side is just as important, maybe even more so, diligently avoiding penalties and interest. These can completely erode any savings you achieved through smart planning, right? So what are the biggest red flags, the major compliance pitfalls corporations need to watch out for, beyond just getting the initial filing done correctly?
You're absolutely right. A brilliant tax saving strategy means nothing if you end up paying it all back and then some in penalties and interest. Vigilance here is key. And probably the single largest area where corporations get tripped up and face penalties is with estimated tax payments.
Paying taxes throughout the year, not just at the end.
Precisely. If your corporation expects its total tax liability for the year, that's the final tax minus any allowable credits, to be $500 or more, then you are legally required to make installment payments of estimated tax throughout the year.
$500 threshold. That covers almost every profitable corporation.
Pretty much. If you expect to owe at least $500, you need to pay estimated taxes. Failing to pay enough or failing to pay on time can lead to underpayment penalties.
Okay, when are these estimated tax installments typically due? Need to mark the calendar.
The installments are generally due in 4 equal amounts. The due dates are the 15th day of the 4th, 6th, 9th, and 12th months of your corporation's tax year.
So for a standard calendar year corporation, that's April 15th, June 15th, September 15th, and December 15th.
Exactly. Those are the key dates. And as always, if any of those dates fall on a Saturday, Sunday, or a legal holiday, the due date shifts to the next regular business day.
And how do you pay these? Can you just mail a check?
Not anymore, generally. It's crucial to remember that all federal tax deposits, and this includes corporate estimated tax payments, must be made using electronic funds transfer, EFT.
EFT only.
Yes. The most common way is through EFTPS, the Electronic Federal Tax Payment System. It's a free service provided by the Treasury Department, and you have to enroll in it beforehand.
Okay, EFTPS. Enroll ahead of time. Good tip. What if a company messes up and misses the EFTPS deadline for a payment? Is there any last-minute recourse to avoid a penalty? That sounds like a potential panic situation.
It can be a panic point, yes. EFTPS deposits typically must be scheduled by 8 p.m. Eastern Time on the day before the deposit is actually due. So you need to plan slightly ahead.
Right. What if you miss that 8 p.m. deadline?
If that deadline is missed, corporations still have one potential option to make their deposit on time. They can use the Federal Tax Collection Service, or FTCS. This service offers a same-day wire payment option.
A wire transfer.
Essentially, yes. However, be aware that this usually requires making prior arrangements with your own financial institution, and your bank will likely charge you fees for sending the wire. While it's a valuable lifeline for avoiding penalties in a real pinch, proactive planning and using the free EFTPS system is always the preferred and most cost-effective approach.
Good to know there's a backup, even if it costs something. What if a corporation realizes partway through the year that its income forecast was way off? Maybe business is much better, much worse than expected. Should they adjust the remaining estimated payments?
Absolutely, yes. It's very common for projected income and tax liability to shift during the year. If, after you've figured and maybe already deposited some estimated tax, your corporation finds its expected tax liability will be significantly more or significantly less than originally estimated, you should definitely refigure your required installments for the remaining payment periods. You want to true up as you go to avoid a big surprise or a penalty at year end.
Okay. And what if you realize you've overpaid significantly through estimated taxes? Can you get that money back quickly, or do you have to wait until you file the final return?
Good question. If you find that your corporation has substantially overpaid its estimated tax for the year, you might be able to get a quick refund before filing your final return. You do this by filing Form 4466, Corporation Application for Quick Refund of Overpayment of Estimated Tax.
Form 4466. What are the requirements?
To qualify for this quick refund, the overpayment must be at least 10% of your corporation's expected income tax liability for the year, and the overpayment must also be at least $500.
Okay, 10% and $500 minimum. When do you file it?
Here's the timing. Form 4466 must be filed after the end of your tax year, but no later than the original due date for filing your corporation's tax return. So April 15th for calendar year, not including extensions. And crucially, it must be filed before you file the actual Form 1120 tax return itself.
Before the main return. Got it. That quick refund could be really helpful for cash flow if you overpaid a lot.
It definitely can. Managing estimated taxes accurately throughout the year is key to avoiding penalties and optimizing cash flow. It avoids those nasty surprises.
Speaking of penalties, let's talk about the estimated tax penalty itself. Form 2220, right? When does that kick in? It often seems like a surprise for businesses who thought they paid in roughly the right amount.
It can be a surprise, yes. A corporation is generally subject to an underpayment penalty if its final tax liability shown on the return is $500 or more, and it didn't timely pay enough estimated tax throughout the year. Enough generally means paying installments that total up to at least the smaller of 100% of the tax shown on the current year's return, or 100% of the tax shown on the prior year's return, if the prior year was a full 12 months and showed a tax liability. There are some exceptions and special rules for large corporations and annualized income methods, but that's the basic safe harbor.
Okay, current year tax or prior share tax, whichever is less.
Generally, yes, Form 2220, underpayment of estimated tax by corporations, is used to figure out if you met one of the exceptions or to calculate the penalty if you didn't.
Is there anything special about Form 2220 we should know?
Yes. There's a critical procedural detail that many corporations overlook, especially now with the potential for the Corporate Alternative Minimum Tax, CAMT, for very large corporations. If your corporation's total tax liability for the year includes a CAMT liability, calculated on Form 4626, you must complete and attach Form 2220 to your Form 1120 return.
You have to attach Form 2220 even if you calculate the penalty and it comes out to zero.
Yes. Even if the penalty is zero because you met an exception, if you had CMT liability, the IRS systems are apparently set up to expect Form 2220. If it's missing, it can trigger an automated penalty notice later on.
Yeah.
Then you have to go through the administrative hassle of responding to the notice and requesting an abatement, proving you didn't owe a penalty. It's a small but vital compliance step to prevent future headaches if CMT applies to you. Just attach the form showing zero penalty.
That is a great practical tip. Avoid the unnecessary notice. Okay, if we connect this compliance piece to the bigger picture, it feels like many penalties arise from simple oversight, maybe underestimating risks or just not knowing these specific rules. It raises the question, are companies truly aware of the potential costs of non-compliance beyond just the tax itself? That sounds like penalties and interest can really add up.
That's a crucial framing, absolutely. The costs of non-compliance can snowball and extend far beyond the original unpaid tax amount. First, there's interest. The IRS charges interest on taxes paid late, and this applies even if you got an extension of time to file. The extension doesn't stop interest from accruing on unpaid tax from the original due date.
Interest starts from day one after the original due date.
Correct. Interest is also charged on most penalties, like penalties for failure to file, negligence, fraud, substantial understatements, etc. The interest generally accrues from the due date of the return, including extensions, until the date the penalty is paid. And the IRS interest rates can be significant. They're tied to market rates and adjusted quarterly.
Okay, so interest is almost always a factor if you're late. What about the specific penalties for just filing the return late or paying the tax late?
There are separate penalties for those. For late filing, a corporation that doesn't file its tax return by the due date, including any extensions granted, may be penalized 5% of the unpaid tax for each month or part of the month the return is late.
5% per month, that's steep.
It is, and it's capped at a maximum of 25% of the unpaid tax. Furthermore, for a tax return required to be filed in 2025 that ends up being more than 60 days late, there's a minimum penalty. The minimum is the smaller of the actual tax due or a specific dollar amount, which was $510 for returns due in 2024, likely similar for 2025. This minimum applies even if 5% of the unpaid tax is less than that amount.
Ouch. Can that late filing penalty be waived?
It can be waived if the corporation can demonstrate reasonable cause for the delay and that it wasn't due to willful neglect. But proving reasonable cause often requires significant documentation and isn't always easy.
Okay. What about the penalty for paying late?
For late payment of tax, a corporation that doesn't pay the tax when it's due, by the original due date generally, may be penalized. 0.5%, half a percent of the unpaid tax for each month or part of a month the tax is not paid.
0.5% per month.
Yes, also capped at a maximum of 25% of the unpaid tax. So if you file on time but pay late, you get the late payment penalty. If you file late and pay late, both penalties can potentially apply, although there are rules coordinating them so they don't fully stack in most cases. The key is file on time, pay on time.
Absolutely. Now, you mentioned earlier the trust fund recovery penalty. That sounded particularly severe, potentially hitting individuals within the company. Could you elaborate on that? That seems like a really serious penalty people need to be aware of, extending beyond just the corporation's liability.
It is arguably one of the most severe penalties in the entire tax code. And yes, its power lies in its ability to pierce the corporate veil and hold individuals personally liable. The trust fund recovery penalty, or TFRP, can apply if certain taxes that an employer is required to collect or withhold from employees, specifically income taxes, Social Security, and Medicare taxes, often called trust fund taxes because the employer holds them in trust for the government, are not collected, or if they are collected but are not then paid over to the IRS.
Okay, so it's about payroll taxes withheld from employees.
Primarily, yes. If those withheld funds aren't remitted, the TFRP can be imposed on any and all persons whom the IRS determines to have been responsible for collecting, accounting for, or paying over these taxes, and who acted willfully in not doing so.
Responsible and willfully. Who qualifies?
Responsible person is defined broadly. It can include corporate officers like the president, treasurer, CEO, CFO, directors, shareholders, or even employees if they had significant control over the company's finances and decision-making regarding which bills got paid. Willfulness generally means a voluntary, conscious, and intentional decision to prefer other creditors over the government, or showing reckless disregard for whether the taxes were paid. It doesn't require bad intent, just knowing the taxes were due and using the money for something else.
And the penalty amount.
The penalty is equal to the full amount of the unpaid trust fund tax. So if a company failed to pay over $100,000 in withheld payroll taxes, the IRS could potentially assess the full $100,000 penalty against multiple responsible individuals personally. They can collect the total amount only once, but they can pursue multiple people for it.
Wow. That is incredibly serious. A huge personal risk for those in charge of finances if payroll taxes aren't handled correctly.
It absolutely is. It's a powerful tool the IRS uses to ensure those trust fund taxes get paid, because that money technically belongs to the employees and the government from the moment it's withheld. And of course, the IRS can also impose other significant penalties for things like negligence or disregard of rules, substantial understatement of tax, and even civil fraud, which carry their own hefty percentage penalties based on the underpaid tax.
Okay, one last area of compliance and penalties. Reportable transactions. You mentioned these earlier. They sound like complex arrangements that the IRS scrutinizes heavily, and failing to disclose them carries steep penalties. This isn't just about paying more tax on the transaction itself, it's facing huge extra fines just for lack of transparency, right?
That's exactly right. This is a critical area requiring vigilance, especially for corporations engaging in complex financial or tax planning strategies. A reportable transaction is essentially a transaction that the IRS has identified through categories as having the potential for tax avoidance or evasion.
What kind of transactions fall into these categories?
There are several types. The most obvious are listed transactions, which are specific schemes the IRS has explicitly identified in published guidance as abusive tax avoidance transactions.
Okay, the known bad ones.
Right. Others include transactions offered under conditions of confidentiality, especially if they come with high advisor fees like $250,000 or more. Transactions where the taxpayer has contractual protection against the possibility that the intended tax benefits won't be sustained. Transactions resulting in significant losses for corporations, generally a loss of $10 million or more in any single tax year, or $20 million in any combination of years. There are a few other categories, too, relating to book tax differences or brief asset holding periods.
Okay, a fairly broad net. So, if a corporation enters into one of these types of transactions, what are they required to do?
They are legally required to disclose the transaction to the IRS. This is done by filing Form 8886, Recordable Transaction Disclosure Statement. This form needs to be attached to the corporate tax return, Form 1120, for each year the corporation participates in the transaction. A copy also generally needs to be sent separately to the IRS's Office of Tax Shelter Analysis, OTSA.
Okay, file Form 88886 with the return and send a copy to OTSA. What about the advisors who promote these things?
They have disclosure requirements, too. Material advisors who provide assistance or advice regarding reportable transactions generally must file Form 8988 Material Advisor Disclosure Statement.
Okay, so what are the consequences if a corporation fails to file Form 8886 when required, or files it incorrectly? You said the penalties are steep.
They are indeed significant, imposed under Section 6707A. Failing to properly complete and file Form 8886 with the corporate return when required, failing to provide that copy to OTSA, or filing a form that includes incorrect or incomplete information can trigger substantial penalties. For listed transactions, the penalty can be tens of thousands or even hundreds of thousands of dollars, depending on the situation. For other reportable transactions, it's typically $10,000 for corporations.
Wow, just for the failure to disclose, regardless of the tax impact.
Yes. And on top of that, there's an accuracy-related penalty under Section 6662A that can apply specifically to any underpayment of tax that is attributable to an undisclosed listed transaction or other reportable transaction with a significant tax avoidance purpose. This penalty can be 20% or even 30% of the underpayment. So the combined cost of non-disclosure can be massive, easily outweighing any perceived tax benefits from the transaction itself. Transparency here is absolutely crucial.
Unbelievably important point. The cost of non-disclosure can dwarf the tax itself.
Oh.
Okay, stepping back and looking at the whole picture, what does all of this mean for you, the corporation listening, as you navigate your taxes using Form 1120? It really means vigilance, right? Proactive planning and understanding that basically every single line item, whether it's income, expense, deduction, credit, even just informational items, has implications for your bottom line in compliance.
It truly does. Every piece matters. For instance, even seemingly simple items have nuances. Take item D on page 1, asking for the corporation's total assets. The amount you enter there, which comes from Schedule L, the balance sheet, line 15D, has a direct impact on other filing requirements.
Also,
There's a practical administrative relief offered for smaller corporations. If your corporation's total receipts for the year, that's line 1A plus lines 4 through 10 on page 1, and its total assets at the end of the tax year from Schedule L, are both less than $250,000.
okay, less than 250K in both receipts and assets.
Right. If you meet both those conditions, and you answer yes to question 13 on Schedule K, which asks if you meet these conditions, then you are generally not required to complete Schedule L, balance sheet, Schedule M1, reconciliation of income per books with income per return, and Schedule M2, analysis of unappropriated retained earnings.
Ah, so smaller companies can skip those detailed reconciliation schedules. That must save some time and accounting fees.
It definitely can streamline the filing process for smaller, simpler entities, allowing them to focus resources elsewhere. They still have the option to complete these schedules if they want to, but it's not mandatory if they meet the criteria. Just need to get that asset number right in item D.
Good practical tip based on a simple box. What about that corporate alternative minimum tax, the CAMT you mentioned? We touched on it with estimated taxes, but just as a reminder.
Right, the CMT. This is a relatively new tax, applying only to very large corporations, generally those with average annual adjusted financial statement income over $1 billion. If it applies to your corporation, you must complete and attach Form 4626, Corporation Alternative Minimum Tax.
Okay, Form 4626 for CMT.
And as we stressed before, if your corporation does have a CMT liability calculated on Form 4626, remember you must complete and attach Form 2220 for the estimated tax penalty calculation, even if that penalty amount comes out to zero. It's that crucial step to prevent those future automated IRS penalty notices.
Got it. Attach 2220 if CMT applies, period. Finally, for corporations that are part of a larger group, what's special about filing a consolidated return? And just briefly, any specific reporting related to those Paycheck Protection Program or PPP loans from the pandemic era?
Right. For corporations that are part of an affiliated group, generally connected by 80% or more ownership, and elect to file a consolidated return, reporting the whole group on one Form 1120, they have some specific requirements. First, they must check the box in item A on page 1, specifically box 1A, indicating it's a consolidated return, and they must attach Form 851, which is the affiliation schedule, listing all the corporations included in the group.
Okay, Box 1A and Form 851. Anything else?
Yes. Beyond that, they generally must attach detailed supporting statements or schedules for each individual corporation included in the consolidated return. These need to show each member's separate gross income, deductions, computation of its own taxable income before consolidation adjustments, its balance sheet, and a reconciliation of its income and retained earnings. It's a lot of supporting detail.
Sounds like it. Is there any relief for smaller groups?
Similar to the relief for small standalone corporations, yes. Certain smaller consolidated groups, those whose total consolidated receipts and total consolidated assets are both under $250,000, may not need to provide all of these detailed supporting statements for each member. Check the Form 1120 instructions for specifics.
Okay, some potential relief there too. And PPP loans, many businesses had those. Any lingering reporting?
Yes, potentially. The income from the forgiveness of PPP loans was generally tax-exempt for federal purposes. However, the IRS provided guidance in Rev. and Pro 2021-48 and others about the timing of basis adjustments and deductions related to expenses paid with forgiven PPP funds. If your corporation had tax-exempt income from PPP loan forgiveness and is applying certain sections of that guidance, it's crucial to attach a statement to your return.
What should the statement say?
It needs to report the specific tax year for which you are applying the guidance from Rev. Proc 2021-48, sections 3.01, 2, or 3, and include specific details for each PPP loan involved, like the loan number and the amount of forgiveness that resulted in tax-exempt income. This just ensures proper accounting and transparency for what was, for many businesses, a very significant and uniquely treated source of funds. You know, the world of corporate tax, Form 1120, it's undeniably complex. There's no getting around that. But, as I hope we've shown today, it's also absolutely filled with powerful opportunities for strategic financial management.
Yeah, it's not just a compliance burden.
Exactly. Understanding the intricacies of Form 1120 and its instructions isn't just about ensuring you file correctly and on time. It's really about proactively optimizing your company's financial health. It's about intelligently leveraging every single available deduction and credit you're entitled to. And just as importantly, diligently avoiding those costly penalties and interest traps. It really requires being proactive, not reactive, when it comes to your tax obligations.
Absolutely. I mean, from the details of the dividends received deduction, which can vary so much based on ownership, to the critical impact of choosing the right accounting method, or just the sheer vigilance needed for estimated tax payments. Every detail on Form 1120 really does matter.
It adds up.
It really does. And knowing about things like the R&D credit or the work opportunity credit or that energy-efficient commercial building deduction, these aren't just small things. They can genuinely shift your bottom line,
Yeah.
freeing up cash for investment, growth, or hiring. So what does this all mean for you, the corporation listening, as you look ahead? It really means approaching your corporate tax return not as this daunting annual chore you dread.
Which many do.
Right. But instead, see it as a deep dive, an exploration into potential savings. It's a strategic blueprint for your company's future financial health, hidden within those IRS instructions. So here's a final thought to leave you with. Consider this. If just being aware today of these specific types of non-deductible expenses, things like those qualified transportation fringes or certain club dues, could potentially save your company thousands by simply not miscategorizing them or understanding their treatment. What other hidden opportunities or maybe pitfalls might be lurking in your corporate financial strategy that you haven't yet uncovered?
Makes you think.
Right. How might a deeper, more ongoing engagement with tax guidance with these details transform your entire approach to profitability? The insights we've shared today, drawn from the Form 1120 instructions, are really just the beginning of that journey. Hopefully, they empower you to make more informed, more strategic financial decisions for your corporation. And as always, for personalized guidance truly tailored to your specific business situation, we strongly encourage you to seek advice from qualified tax professionals. They can help you navigate this complexity effectively.